While many, ourselves included, had expected inflation to begin abating by now, the recent data from January shows it is not. After seeing headline inflation for December at 7%, we got a headline reading of 7.5% for January. Even when we strip out the more volatile food and energy sectors to view the more core rate of inflation, we saw prices increase year over year at a 6% rate, far above the Fed's target of 2%. The Federal Reserve expected inflation would accelerate coming out of the pandemic-induced recession and had communicated a willingness to accept inflation above 2% for some period of time. But it is now clear that inflation has lasted longer and accelerated to levels the Fed did not expect, levels that now require action. As little as 3 months ago, the Fed was communicating a gradual pace of reducing accommodation by slowly ending their practice of buying bonds on a monthly basis and then reassessing the economy and inflation to consider possible interest rate increases. The outlook was for a potential for 2 rate increases in 2022. As we talk today, the outlook is for the Fed to finish their bond buying by March and now pursue 6 or maybe even 7 rate hikes this year. In fact, after last week's CPI release, the market began anticipating the possibility of a 50 basis point move in March, double the amount the Fed has normally pursued. This rapid shift from the Fed has introduced heightened volatility in the stock and bond markets and led us to incrementally reduce risk in our portfolios. Importantly, we're not overly negative on the stock markets as our outlook for growth in the U.S. remains positive, with a strong job market supporting a consumer which is, overall, still in good shape. But we will have to watch the economy closely over the next few months. The outlook for rate increases is much more aggressive now, and higher rates could impact economic growth, the stock and bond markets, and markets like housing where mortgage rates have moved up. The Federal Reserve has a tough job to raise rates enough to slow inflation without raising rates so much it leads to negative economic growth. It is prudent for the Fed to move now, but we also know our economy and inflation can change rapidly. Our goal is to try and make sure we manage portfolio risk in the short run while making sure we keep your longer-term goals and objectives in mind. We will continue to update you as conditions warrant, and thank you for putting your trust in BOK Financial.